Okay, my good people, my ladies and gentlemen, my brothers and my sisters, the acid clergy, my beautiful heretics. Yes, yes, welcome back to the liturgy of disbelief. Today's title should be, let me think, the Shadow CPI. Or better said yet, How I Learned to Love the Bootleg Bureau Tapes. Oh yeah, the Bootleg Bureau. It is Thursday. I believe, for another 3 hours, we will call it the 9th of October, 2025. And Washington, that grand cathedral of, some would say, incompetence. Others would say do-gooders. But whatever, it remains shuttered, closed down. Day 9 of the shutdown, which coincided with a valiant attempt by me to do a daily podcast. I'm losing my mind. So with the statisticians, there's a word, still on sabbatical. See what I'm doing there? Am I doing alliteration? Maybe. What is alliteration? Alliteration is using a lot of. What is alliteration? Statisticians. And that sounds like onomatopoeia, like sludging through trudge. Anyway, let's move on. We're not doing English. We are doing economists. And the public ones, maybe they're polishing their LinkedIn profiles, looking for a higher paying gig in the private sector. Maybe. Again, okay, focus. Yes, the public scoreboard. Yeah, the scoreboard from the government is blank. And the nation is flying. It's flying by a high wire act. And yet in the dark, what is it I hear? A new choir. I sound like Bono in Rado and Hum. I was walking through Harlem and I met some friends. The new gospel choir of Brooklyn begins to sing. And enter OpenBrand. Yeah, it's not the same. We've just lost Rado and Hum. I now have to talk about a data analytics firm. Let's start by saying, good on them. Did they decide that God is dead and this is as good a time as any to maybe to found a new religion of faith, a new narrative, a new gospel, a new preacher? Because they appeared out of the blue and jumped into my consciousness today, took me by surprise, crept up on me. Them and their fresh, like a donut, consumer price index. And you know what? The buggers, they grabbed all of today's attention and headlines. They even, for a tiny minute, I think they moved prices just a little until pros like me went, whoa, say what? Say that again? Who the fuck are you guys? Forgive the French. Because my initial reaction, I accepted. I was like, oh, they produced CPI data. I thought the government was in lockdown. There was literally no caveat in the headlines. There was nothing warning the gullible. It's been removed from the diary, the dictionary. The gullible people would believe diary. It has not been removed from the dictionary. The dictionary, yes, is maybe still in the diary. What am I talking about? Have I been drinking? No, I have not. I am sober. I'm talking about a new trade hustle, a statistical hustle. With the competition, with the big boys, the IBMs going on leave, the OpenBrand saw an opportunity and released the little cookie CPI measurement. And now, again, the clue should have been in the headlines saying this is made up, this is new, it's kind of phony, it's kind of fake. Fake, it's trying hard, but when I say fake, we don't have years and decades of data. In fact, the clue was the lack of year over year comparisons. I was saying to myself, okay, yeah, the month over month, but where's the year over year? These figures seem high. I mean, I read these figures and I was like, oh shit. Oh my God, I dare not look at the dreaded TLTs. More on that later. But there isn't a year over year for this data series because they've not been going long enough, my friends. They started this gig in February 2025 when I was sending heartfelt and very, very sincere Valentine cards to the most beautiful ladies. These guys were preparing. They were preparing a price index for all the nuts and bolts that their little consultancy follows and covers and comments assiduously upon. And again, the financial journalists, seriously, shame, 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 trying to pass this off as the real deal. You know, the OpenBrand CPI. And without no shame, US prices, the headline screamed. I mean, it's on your screen. US prices rose 0.6% in the month of September. Of course, they were more precise, but I will not give them the satisfaction. You know me, I am not breaking my decimal point rule. Yes, the headlines had a decimal point. Anyway, I think you can imagine my indignation. You can hear the indignation in my voice. Them trying to hawk me the yarn that prices rose a tenth of a percentage point. Oh, I'm going to throw up. A tenth of a percentage point higher than in August. A tenth of a percentage point faster than August. The attention garnered today by that headline is exquisite nonsense. I mean, good on them for the social media hits. I mean, I'm not helping here. I'm helping them. I'm talking about it. So shame on me and the rest. But at least I'm calling it out. And note, and again, indignation, note, CPI is goods and services. And America is predominantly services. I think 71% of the CPI basket. And this was just goods, and not even all goods. Christ almighty. They did, however, let's give them some blessings. They did claim that the big jump, you know, that tenth of a percentage point jump in September, comes from the end of the what's called the de minimis exemption. You know, that rule that let Americans import small goods duty free. Yeah, that's gone. That loophole has been filled. Your face cream from Seoul is now got a tariff handle on it. And so the consultancy boys, not the Bureau of Inflation or whatever, but the Open Board are telling us inflation is reborn. Just imagine the sage, Jerome Powell, the most boring man in the world, nodding politely, probably sipping herbal tea, whispering to his aides, sure, we're data dependent. Let's call it data. Let's watch this, guys. This is interesting. No, it's not. It's not evil. It's entrepreneurial. When the state stops measuring capitalism, what do? We improvise. And so today, we filled the void with barcodes and brash confidence. CNBC flashed their charts, traders tuned in. Heck, if it moves markets, it's the truth. But again, remember, I mean, what was even the statistic? I said 0.6 month over month. No rent, no healthcare, no education, no electricity, nothing fudged, nothing made up, just gadgets and lip gloss. Who am I to sneer? At least government, I can't call them lies, miscalculations. At least they come with copious footnotes. This stuff, these numbers arrive with hashtags and fucking emojis. Anyway, God, I really got a little bit carried away there. I do apologize. Anyway, we did get a proper data point. Jobless claims crept up to 258,000, which was a soft miss. I mean, it's barely worth a shrug, but we can just, I thought we could just, I mean, it's a government data point, that rare thing. It was slightly higher, so you don't want to be high on this. These are weekly filings from the folks freshly out of work. And the guesstimate had been 245,000. So it was a bit higher at 258,000. I like this indicator because, if obviously it flags labor market chills before the payroll. The Bureau of Labor Statistics, the BLS, it crunches them federally. It's timed every Thursday at 8:30 in the morning Eastern time. And they say that essential stats, and I like that the jobless claims is deemed to be more essential than the non-farm payrolls. And so it's still rolled out. The staff deem it critical. It's a bit like my Hurricanes National Weather Service. No furloughs there. Over the last 12 months, so what did the reading today for the claims, not the hurricane, was 258,000. And over the last year, it kind of started at 240,000-ish. So fewer claims. It dipped all the way down to 192,000. So a lot less people having to file for unemployment. That was March of this year, during what seemed to be an AI kind of, tech hiring frenzy. And then you remember we had that big sell-off. We had the Nasdaq down 25% from its peak, plunged below its 1-year moving average, confusing all of us. And coincidentally, we had a spike to 300,000 in July, and we saw quite a lot of layoffs. So today, 258,000, kind of slightly above where we started this point last year, near the highs. But this is not a recession. This is not a flag yet. Cruising. We're more Tom cruising than Tom crashing. And then, oh my God, J. Powell, he spoke in Dallas. But Dallas or Texas on my bucket list. Oh, I'm determined to find myself a southern lady. And everyone I meet from Texas just seem to be the nicest people. Anyway, J. Powell, I would recommend that in the years following him stepping down, due to step down next year, next May, I believe, I think he should launch a sleeping app. I mean, he just sends me to sleep. Monotone tones, forward-looking, data-dependent. We are vigilant. Wake me up before you go. Another data point, which I kind of like it. It was the 30-year bond auction. And the headline was it cleared at 4.45% yields. So what that means is the government sold a lot of very, very long maturity debt claims at a slightly better price than they managed the last time. Why do I like it? Because hardly any amateurs look at it. It's rarely quoted in the dumb press. And, the government sold 22 yards. 22, I mean, 22, if you were having an IPO and you were selling 22 billion of new equity, that's a big deal. I mean, when we go back to Grayscale, and that would have been 2021, I want to say, and Kyle, can't recall Kyle's surname, but Kyle from Three Arrows came in, and he was getting the closed-end fund to issue stock at par with a 6 to 12 month lockup. And so he was buying Bitcoin, and Bitcoin via the ETF was trading at 40-50% premium. And so he was looking to Arbit to buy it at book and sell it at the premium in the anticipation that in the 6-month lockup, the actual spot Bitcoin price would be higher. But it wasn't just Kyle, and Kyle was doing it with a lot of yards, and he had a lot of people following him. And I think at one point, when all of that stock was then free for them to trade, I think they would have been looking to sell 40 yards of Grayscale stock. And sell it to whom? Because by the time it vested and they could sell it, you didn't need Grayscale to buy Bitcoin. There were futures, there were Canadian ETFs, that you had options. And the stock dived. So 22 billion 30-year auction today. It's a big number. What do we know? Demand was rock solid. The dealers kind of underwrite the thing. They kind of buy if no one else buys it, and then they've got inventory and they can hold it and they can try and sell it at better prices by being patient. They grabbed 9%, and that's way below their usual. So that's a good thing. That means legitimate demand. And then you got these, they're called the indirects, kind of sneaky foreigners and investment funds. And they took 64%. I mean, I'm not trying to make a big deal. We have these auctions all the time. This is not a huge deal. I'm just saying, in the absence of other data, not bad. In the, everyone groaning and bitching about Treasury bonds, not bad. It shows you, again, hyperbole. It shows you that global money's still hungry for US safety. Remember, last night I was saying the US is confronted. It has these higher risk-free rates. That's a magnet. What are you going to put your money at zero in Japan? Literally zero or negative in Switzerland? Or are you going to get, what are you getting, about 4%? Well, here you're getting, well, okay. But no, I was up and down the yield curve there like a hooker's drawers. Is that what they say? That sounds rather rude. But my knickers were up and down, up and down, up and down across my knees there. I was mixing cash rates so that I think the 1-year Swissie's gone negative, maybe even the 2-year. But we're talking about 30-year here. And we were saying 4.45, and I was talking about the Japan 30-year yield being 3.2, if you remember when we were discussing this on Monday, and we were discussing the 5% rally in the Nikkei, and the expectation of a renewed vigor in their fiscal expansion with the appointment of Madame's a name I cannot remember, but we love Madame Takachichi. I made it up. Sorry, of course I made it up. Global money, that's what I was saying. Global money's still hungry for US safety. And US rates are high, so 4.45 versus 3.2. 3.2 is a very extended level in Japan. The US is higher than just about everywhere else at the 30-year level. The short rate's higher than just about everywhere else in the developed world. And then the expected return from investing in the equity market or the private markets is like 15 to 20%. So that's the era of US exceptionalism. Like the US is the magnet for the world's capital. And anyway, it allowed for me to just remind you of the macro compass. 4 quadrants: equities, the treasuries, cash, and the dollar. No, heavens, I'm missing something. So cash, dollar is one segment. And the other segment being alternatives: gold, Bitcoin, private equity, commercial property, index-linked bonds, that sort of thing. And our role is to navigate that compass, to look at that compass, to be cognizant of the components of that compass, to make allocations which give us an exposure to those 4 sections, and then you use our precocious and eclectic minds to fathom an allocation that reflects our view of the future. And I think at that level where you've got these essentially 4 quadrants, those quadrants obey mean reversion. And we saw that very clearly 2008 to March 2009. I want to say the S&P fell 60% from its high. 60%. In fact, I was looking at the SPY, the ETF for the S&P 500 earlier, and I think the low was, let's call it 66, almost the sign of the devil. And one of my great shames, keep using this word shame, and actually I must drop it because shame is the lowest state of being. One should never be ashamed. If you hear yourself saying that, give yourself a red card, go and brush your teeth, and remove it from your lexicon. Message to myself. I should have bought the S&P in March. Actually, do you know what? I should have bought the S&P in April at 86 and not 66. I've still got Paul Tudor Jones barking in my head. 1 year moving averages had turned, spot price was above, and you'd had a profound mean reversion. Contrast that with the Treasury. So that's a quadrant in itself, a quadrant as mighty as the quadrant occupied by equities. And we were talking about the 30-year auction. The price of the 30-year since 2021 has fallen 60%. The well covered, the rock solid demand for the auction today. Question, is that investors buying a bottom? A bottom long in formation? Did anyone say TLT? Oh, tilts. I'm blushing. I was actually on Super Grok today. I said Super Grok and my computer flashed up. Hence the pause. Blush. Does it flash again? No. But it clearly has the Twitter archive. And so you can actually retrieve tweets. And so I said, hey, when did this bozo Hugh Hendry, when did he first publish anything bullish on the TLT? And it comes back at me. July 7, 2023. The day I will never be allowed to forget. I get absolutely crushed every day on by the good folk. You know, the gold mining folk and whatever. Hey, how's the TLT going? Well, price is pretty flat since July 23. I mean, it had a few precarious spikes lower, which never changed my opinion. And in fact, it helped me create a new rule, the Niederhofer rule of 5%, which I think has so far added way more to the community than my bullish stance. You know, the Niederhofer rule is, I mean, you can count with one hand the number of weeks the 10-year Treasury has yielded more than 5% in the 21st century. Here we are, and a quarter of the century's over, and I've got 5 digits that can hold weeks with a yield above 5. Think of that, how rare that is. Niederhofer rule is saying there's the US and probably modern economies are just not built today to withstand a risk-free maturity rate of 5% or greater. And a lot of that, if you can recall the Kobayashi Maru, and I'm going to say it again. I mean, well done the US. At least the Fed had the ability to take short-term interest rates to 5%, to 5.5%. Imagine Japan attempting that. And that is impossible. The servicing and then the maturity of those bonds accounts for about 1/3 of the government's direct spending at zero interest rates, or not far above. So imagine it at 5, and like I say, and I got this pretty well. I was good on this a year ago when the Bank of Japan was saying we're going to raise, we're hiking. Like, no, you're not. You're nothing but the Bank of England. Just before the currency was evicted by Soros from the exchange rate mechanism, you're at 12% interest rates, and you're claiming you can go to 15. You're done. The enthusiasm for the bonds, I retain that enthusiasm. I retain that inherent trader's knowledge that this is a bottom. But I have to caveat that. There's a inglorious saying that monkeys pick their bottoms. And in July of 23, I was an ape. I was Monkey Man, one of my favorite Rolling Stones songs. Monkey Man. Picking a bottom. Picking a bottom without a rising 1-year moving average. Picking a bottom with the spot price below the 1-year falling moving average. But to my credit, I kind of knew some of that, which is why I'd advocated a position with regard to a call option, a 1-year. I think we could roll. I think we were getting 18-month. Correct me if I'm wrong. Call options, and then the ability to roll it forward to get that 2 years. That 2 years of guessing whether the contentious narrative would come correct. It is so far confirming the notion of a bottom. It is, however, yet to give a buy signal. And 2 years have passed, and I'm timed out. I'm closed. And that's fine by me. I have to just close the grief that I have that I didn't hoover up the S&P in March 2009. I have to get over that. But I will say again that I can conceive of another engagement with the TL team. But let me be certain here. I cannot conceive of another long engagement until the price trades above the 1-year moving average. Stranger things have happened. But if there's a lesson in this ramble, the monkey man rambles through the jungle, you don't short all-time highs and you don't try and buy all-time lows. You're patient. You're patient. Well, I tweeted today. What did I tweet? Let me see if I can find it. I'm jumping between screens. I'm saving a draft of something I was going to send out. I'm going into my profile, talking out loud. Yeah, I said investment is 1/3 imagination. It is 1/3 waiting around. And actually it's probably longer than 1/3. And it's 1/3 knowing what to do when the shit happens. And I feel like that 1/3 waiting around, I feel like we've gone through that. We're getting close. We're definitely getting closer. But as a trade, it was closed out because the fiscal data, the pump priming to steer the economy, steer is an interesting word, out of the pandemic was overbaked, clearly. But it's overbaked and cemented into the system until 2027. The economy just has not slowed down and given the recession forecast that the TLT would need. And, again, if we look at the entrails of the data today, mauve, amber, nothing flashing red. We even had Jamie Dimon. Me and Jamie could be a double act in terms of like bearish prognostications. Jamie was warning there's a correction sometime in the next 2 years. Oh wow! Oh, you don't say, Jamie. Of course, there's a correction sometime in the next. Let me qualify that. Qualify it. Let me go further. There's a correction sometime in the next 1 year. There's a correction probably in the next 6 months. What is a correction? What is a correction, Jamie? I think you mean a reversion to the mean. We were discussing that. Spot prices will trade back to the 1 year moving average. Typically, that would mean somewhere like a 15 to 20% drawdown in indices. And so with specific risk, there'll be stocks that fall 40, 50%. But that's what markets do. Jamie's as promotional as OpenBrand. He's like, oh, I'm over here. There's no government, but I'm over here. He's a meteorologist. You can tell I've been looking at these hurricane maps today. Supposedly there's another big storm coming in tonight, but I have not seen. I have this incredible. I look due south, and the lightning storms that I get treated to are insane. Anyway, Jamie, the meteorologist that forecasts rain just before death. Like, who cares, Jamie? We're all gonna die. But we'll keep an umbrella handy. Let's wrap it up. Wow, it's 20 to 9. I'm a little bit early. I'm going to get to bed maybe at 10 o'clock tonight. Hallelujah. Talking of the end of the day. The day ends as it began, with the counterfeit of certainty. What will we deliver today? A fake CPI. A fake plastic tree. A cautious, when is it not, Federal Reserve. It reminds me of something I said on Odd Lots, the Bloomberg thing. Hey guys, have me back. The science of finance should be left alone. The science and the arithmetic of finance, leave it alone, folks. We must embrace the art of the future. The formation of a contentious narrative, and the adventure of trying to persuade many in the belief system that might take hold. Today we got a different form of art, invented statistics, painted in real time on real Bloomberg screens. We are the civilization that prefers give me an approximate story to an inconvenient silence. Perhaps that's why I keep talking to the end and well beyond the end. I'm sure when I'm sleeping, I'm talking. Acid breath, my brothers and sisters. It was never about certainties and more about the theater of uncertainty. Every night I sit here with the jazz, with the Caribbean wind. Oh, there's not much wind tonight. The shutters are still. I'm sitting outside and I'm trying to make sense of numbers that, quite frankly, no longer mean what they say. Markets move typically up. Algorithms seem to gossip with each other about how dumb we are. And me, your macro savant, I'm interpreting the noise as best I can. It's ridiculous. It's also rather wonderful. And so here's your benediction for tonight. I want you to breathe in. And I want you to breathe out. I want you to treat every data signal like it's a rumor, every policy like it's performance art, and every closing price as a confession about what tomorrow might bring. To the good people, I am Hugh Hendry. I am in St. Bart's. And I am signing off beneath a blacked, inked out sky. I'm grateful to the hustlers who keep inventing the light of the market day. Bisous, my heretics, and until tomorrow. Tomorrow, bisous.